So I'll kick off. What are we going to talk about? Accountant engagement, effective bookkeeping, source documents, expenses, compliance requirements, financial year end, working on your business, and at the end we'll talk about questions. Accountant engagement. Really, you've probably got to think about, well, what is an accountant before you engage them? And actually, it says accountant/bookkeeper versus accountant up there. It might actually be three things: bookkeeper, accountant, and then chartered accountant, which is who you would normally engage. A bookkeeper perhaps is someone doing the administration side of things in a business, and the better you can do your bookkeeping, the better the communication is with the accountant or chartered accountant. Really, the difference between an accountant and a chartered accountant is probably the nicest way possible, is the level of training and the level of assurance that the advice being given is to your best interests. And that's really where a chartered accountant comes in. And a chartered accountant is someone who's qualified to basically join the College of Chartered Accountants, which has changed names many times over the years. When I started, it was ICANN's, Institute of Chartered Accountants, then it was NZECA, so it was the New Zealand Institute of Chartered Accountants, and then more recently we've joined with Australia for many reasons, which I won't go into, and called CANS, which is Chartered Accountants Australia, New Zealand. When I say this evening I won't go into, I've been asked to try and dispel the myth that accountants are boring. So, and discussion with our photographers that she'll let me know if I need to move on, so I'll move on. What is CANS? CANS is our governing body. We as accountants we've got our own act that keeps an eye on us, which is, they haven't changed the name hasn't kept up, but it's the Chartered Accountants Act of 1996. I think it was amended in 2010. Either way, I'm bound by an act to abide by many rules in terms of integrity and avoiding conflicts of interest, and just basically doing the right thing by you as a professional. So before I can do any of that, engaging an accountant requires a formal engagement, very similar to engaging a lawyer or a good lawyer, in that it has to be clear and documented my obligations or a chartered accountant's obligations to you as a client, and also your obligations to the accountant or accounting firm in providing the right information and, again, the good open communication so we're all smiling. There's different types of accounting. This conversation comes up a lot as technology moves forward, but really my business is changing. It's changing a lot. In the past, you probably think of the old bean counter hacking away at goodness knows what they used to way back, but anyway, calculator, computer, more modern. And compliance accounting is keeping score, recording history, telling you how much tax you've got to pay, letting you know how you went for the year. Maybe some advice based on that, not too much really. And that was fine in the old days. Things didn't need to move too much. Business advisory is really looking forward, and that's where you're really getting value from an accountant. And when I say that, it's because times are changing. The likes of Xero and other accounting software packages do so much of our backroom work now, and that's a good thing, I think. There's really no value added to me telling you about the past. That could be the old boring accountant thing. So it's really using that information and going forward, and that's where a good chartered accountant or business advisor who's looking at lots of businesses all the time, looking at different levels, different problems all the time, can provide good advice. So, and of course we're in business. We all must know Uber taxi type thing. It's not my key thing that's being used, but we're being Uberized as accountants. A large chunk of, in fact, professional sector is being taken, a chunk of the work is being taken by good computer software that can do a lot of it. Financial modelling, so financial advisor one day, the camera person's yawning. Financial planners, although you've really got to have a good financial planner to give you good advice, but a lot of their modelling can be in reports, can be just tuned out by a computer program that'll ask you questions and then say, oh, you need to do this, this, and this. I hate to say that, but so those guys are being Uberized too. Then there's specialist accounting, and I've already had a discussion about that this evening, which is specialist tax advice. So beyond bookkeeping and business advisory, there's getting things, ducks in a row around structures and what have you, future planning, international taxation, whatever's going on. And that's really high end, and those guys are working more in the law field. And a good tax advisor really probably can't even use a calculator, to be honest. It's a good sign of a good tax advisor. Auditor, yeah, they're basically counting the bodies after the war, which is how I was taught when I studied it. So an auditor comes in and makes sure that things are what they should be, and they've got the right numbers there, and reducing risk. And then risk management again is looking at structures, insurance, and it's just taking accounting even more widely, and on from there. So a lot of that comes back to in accounting and business advisory is identifying needs. What are your plans, future goals? So minimising that risk. So that's engaging the accountant. Back to the people in the room, really. Tips and advice on making me smile is about perhaps good bookkeeping at your end. It makes your life easy. So really, what's bookkeeping? And I looked this up. The activity or occupation of keeping records of the financial affairs of a business. So bookkeeping is really administrative to an extent and throughout the year. And it's a hassle for a lot of people, especially if you're in business and you're doing business. Last thing you want to do is bookkeeping. And if you're not a big enough business to have an internal administrator or a bookkeeper, you've got to do it yourself or it's just too expensive. So really, ideally, it's as efficient as possible and what works for you, keeping tabs on things. So what is bookkeeping, other than the official definition? It's really the transferring of source document information into manual cash books, which I'll talk about briefly tonight because I think it's still relevant, and manual cash books and records into a computerised system. So it's that very first step, the bookkeeping of keeping the score. Ways to do bookkeeping where it's effective. Well, cash books, as I say, they're still relevant, especially if you're new in business and you're wanting to save a few dollars or you don't have many transactions. You don't need Xero or MYOB. I mean, it's great. It does lots of stuff. It does save you lots of work if you've got lots of transactions. But if you've got a few, well, as long as you're doing it properly, you can calculate your GST and do everything, which effectively all that system is a computerised bookkeeper. Takes the source information, processes it, churns out a GST return or report or something to give to your accountant or chartered accountant. So ways of doing it manually are the good old cash book, which that dates way back to people in business, especially when we had cash. Long gone now, but it still relates to a bank statement. A petty cash book, so that's just keeping tabs of where your bits of cash go, as you probably know. Invoice book is very important, and that tells you so much. It's a key source document if you're in a business which is producing invoices as opposed to a purely cash business, which is likely to land in a sales book. I know a good local hairdresser who still has good cheap haircuts, hopefully she thinks so, but anyway, and she doesn't have FPOS, the price hasn't changed for years, and she's got a sales book, and I like it. And she's in control. I guarantee her GST is spot on. Cost and price is probably quite easy, just do a head count, literally. A wage book, that again is a type of book, source information that's going to feed into where to from there. There's compliance and there's recording of wages throughout the year. Things need to balance up, again, when they come to the accountant, hopefully. And an asset register, so that's useful, especially as you grow, just to record what you've bought through the year and what you continue to hold. So, what stuff relates to your business. It's good at any time to sort of have stock of that. When you go, well, got these things in the shed here, I bought those, are they the business? Or, so just keeping tabs on that. Pays to keep on top of it. This is an example of a sales and income cash book. Probably looks a bit scary if you're not into it. It looks very accountanty, I think. But it's really quite easy. And again, if you're in business and you just got a bank statements you're downloading online or looking at it online, you can probably do this yourself in a spreadsheet. Saves the old adding it up in a cash book and then coming out with a number. But basically, I'll just choose one line. You've had a sale and someone's given you $2,000. We'll ignore debtors at this stage. Money goes into the bank. So you've got your bank statement in front of you. You go, money's come in. Okay, I'll write that in my cash book. You'll write what it's for, which is generally sales, excluding GST, and the GST component, which of course total to add to the 2,000 into the bank. And this straight away is the beginning of your bookkeeping to do two really good things. Well, two things. Firstly, GST. So straight away, when you're doing your GST, whatever period, monthly or 2 monthly, it's just totaled up all your GST for you. So you can work backwards, hey, there's my GST return, as good as done. It's recording a sales figure excluding GST, so here's what I've sold throughout the year in terms of taxable profit, totaled at the bottom. Again, if it's in a spreadsheet, it's going to do it perfectly. So you know sort of where you're going, and it's actually that in that form in terms of sales alone to start with, and with very little else, is good enough to give to an accountant, as long as it matches what's in your bank. We'll go, okay, well, you've said that's what it is, and it's a sales, and it's GST, and you've returned that. I guess the key there is really identifying, well, that's what it is. You know, you make mistakes, and what was that money come in? Oh, I forgot that came in, forget the GST or whatever, could be interest. So little errors and things, but really, really simple, especially if you've got a few transactions, a few sales, or if it's a constant transaction. The same applies for expenses. Again, you could just knock this up in Excel. And you'd need more columns, of course, because it's not just sales. So there's purchases, which if you've got a business which is trading in stock, so you buy stock. So purchases are purchases. Purchases is not all encompassing. I spent some money, it was a purchase, or a general expense. Wages, which doesn't have GST, and rent, and you tailor those to what's in your business, what are you actually doing. So they're your expenses. So for every movement, including GST or not, that goes through the bank, you go through your bank statement, which of course you can download in Excel, and plonk it through your spreadsheet, come out the bottom, it'll tell you your GST, and you sort of have confidence, hey, that's what's going on. It makes you think about every transaction too as you're doing it. So when you're in a small business, you're going, oh gosh, how much did I spend on entertainment? Or whatever it might be. So that's the basics really, and that is actually all that's behind Xero. And Xero has got all the bells and whistles, and it's on the cloud, and it does a lot of other things now with bells and whistles, but really that's how it started. It's a cash book. It's a bank statement coming through the cloud. I'm not into IT, but lands in the software, and ready for you to decide whether it was a purchase or a wage or a rent. And of course Xero gives you suggestions from what you said it was last time, and that's about it. And out the bottom pops GST, out the bottom pops totals of purchases for certain things, and totals for sales, a profit and loss statement, and a balance sheet, and a smiling accountant, hopefully. Smiling clients too. So yeah, I mean, again, it all lands into a computer system. There are lots. I'm certainly not plugging Xero, although I think it's great, but it's a cost. And again, if you're in a small business with few transactions, why spend the money just to have it live and online when your bank is anyway? The thing about Xero, it was the hi, welcome. It was early on the cloud and on the fly, so regular updates directly linked to your bank. BankLink is not as constant or live, but it's sort of the same thing with add-ons. And MYOB Xero kind of combined the two together. So MYOB is catching up quickly. They've bought BankLink, so no one is necessarily better than the other. They're all slightly different, but Reckon is the new name for QuickBooks. I don't really like the name, not really relevant. And they're live as well, so they're all much of a muchness software packages, and there's others trying to compete. The beauty of them is you can add on other things. So as you grow, you can add on a wage app or a whatever app. So as you grow, it can do things and report on different things. But the underlying basis of it is a cash book. Source documents. Well, before you get to even Xero or your cash book, there's got to be something going on. But in saying that, of course, with B2B, it's getting so electronic that virtually your invoices are going to be automatic. Or I had a discussion with someone the other day about you go into MITRE 10, you'll click a button or something whilst you're swiping your card, or even walk past it with your card these days, and it will take your receipt from MITRE 10 if it's business related. It'll code it all through your system, come out the other end, calculate your GST, tell your accountant what you spent your money on, and job done. And it's happening, it really is. And that's, I guess, so long as we're okay with it. I'm not talking Big Brother so much, but the barcoding of everything you are doing, it all comes down to a transaction. That's part of the Uberizing I'm talking about of the accounting profession anyway, or certainly the bookkeeper. It's technology, so change the way we live. So, what are source documents? Well, basically it's anything the result, that's caused something to happen. Bank statements, credit card, deposit books, loan statements, invoices, it's all a movement of a currency or a figure. I'm just going to step slightly to the side here and just say that in accounting, especially when you're not just keeping score, these movements are actually something that's happening in the world. We're putting a dollar figure on it. Don't want to get too unaccountanty for you. But someone's made a decision to buy something or get a service or change something going forward. changing a structure, set up a trust, whatever they're doing, it's a result of something coming on, or something happening in people's lives. So that's part of the scorekeeping, it's still part of the planning, and it actually all comes back to bookkeeping. We put a number on it, I guess. Usually there's more behind the scenes. I better haul myself back in. Righty, so expenses. Well, that's the most common thing, question I get asked anyway, is what can I claim? Please, can I claim it? Or the other one is, I'll claim it, and I'll put it all in front of the accountant at year end, and if I get away with it, it must be okay, because he's looked at everything, which I certainly don't, and no accountant does. We basically take a lot of your source information and your bookkeeping and then process it into what's required going forward, be it a tax return or be some planning going forward. So I think to keep smiling, it's probably good if you know yourselves really what you're okay with and can do a lot of the calculation behind the scenes yourself, especially if it's something useful like a claim that you know, oh, I can claim that each month, I can do that. So, I mean, I've just listed a whole lot of standard things, rent, repairs and maintenance. There's distinctions between that and a capital purchase, of course. Raw materials for trading stock, your electricity and phone, your vehicle and travel, interest on business loans, interest on underpayment of tax, which sometimes people don't think about, because effectively you're borrowing money to not pay your tax. Insurance of business assets. So, of course, you get charged interest if you sit in arrears with tax by Inland Revenue. So they charge you interest. It's like a loan. Not a very good bank, Inland Revenue. I wouldn't borrow money from them, that's for sure. I wouldn't give the money as a deposit either. But anyway, ACC, certainly deductible. And entertainment, which can get a bit more grey depending on people's approach, is generally 100% or 50% deductible. Depreciation on assets is a deduction, as are home office costs, which when you're in a small business, that's something to definitely think about. What can you claim? Examples of non-deductible are improvements to plant and machinery. Now, in theory, it's possibly deductible over a long term by way of depreciation. Private expenses, really, again, smiling accountant and smiling client if you're not trying to push too much insurance through that's really not related. So it's good to unbundle your insurance if you can. It saves us packing through at year end. Drawings, and there's always confusion around that because drawings often become a wage later on, so that's a discussion you have at year end with your accountant for tax purposes. Sometimes I just say, well, if you're making a profit and you can pay your tax and you're budgeting well, take what you need and we'll, there's money there, you're doing well, and we'll worry about it at year end to an extent. There's some planning in there, of course. And capital expenses, so one-off payments, they're not always just going to be a tangible, depreciable asset, but they may be depreciable subject to what it is. And this is often missed, good if you can go and claim it as you go through the year, is lesser items under $500 before GST. Generally, you get an immediate deduction for, meaning you don't have to depreciate it. It's like expensive cordless drill or something, just put it through. And that's an allowance under the Income Tax Act. Motor vehicles, biggie, big cost. Vehicles are expensive, one way or another. They're costing some money somewhere and used a lot. If you're a sole trader, which is often the case when you're new in business, you want to be claiming your vehicle use. It's a bit of a hassle, but keeping a logbook for the first 3 months every 3 years, especially if it's when you're using it a lot, keep an eye on it. And again, you have to check it if I had a busy 3 months and then I put my feet up. Well, you don't push it, but and without a logbook, you can claim up to 25% of costs, but you've actually got to justify those costs. Sometimes a logbook's a good thing, depending on how much you use your vehicle for your business. Trading from a company, well, if you're using your own vehicle, and which is probably a good idea, this is not giving tax advice, but if you're a small company, and it's good to have a company, generally, depending on what you're doing, but you don't want the company to own your vehicle because of FBT issues and deemed dividend issues, and it goes on and on and on. You might want to charge the vehicle to the company based on a mileage, and there's a specific rate, which again, they keep changing, but I think it's 74 cents a kilometre. Worth having, because unless you're driving that includes depreciation, a very, very thirsty, expensive vehicle depreciating quickly, that's pretty good. FBT is messy, costs money, you have to go there if you do, but best avoid it if you can. When I say avoid it, I mean structuring appropriately. Home office, claim it as you go, then you're definitely smiling. Don't forget the GST. So it's a really easy calculation. You know your square metres of your house and the area of the office, which is principally used for running the business. That's the percentage of those costs listed there, and I'm sure I've missed some, like the wheelie bin, or if you can bring it in and justify it. It's tax deductible, and there's GST, excluding the mortgage interest, of course, because there's no GST content on it. So as you're going through, claim it throughout the year. It's good for cash flow, at least for GST. And if you're doing it correctly, and you know you're doing it correctly, and you have a good relationship with your accountant doesn't have to go there. So everyone's smiling. We say, hey, home office, cool, you've claimed it, it's all good. You do it every year, move on. Telephone costs. This is one not to miss, 50% generally. You've got to genuinely be in business. Something too casual, I wouldn't, you make losses year after year, you're not, after a period of time, might raise an eyebrow. But 50% of the business, especially a landline, hopefully people are calling you about the business or you're using it to call out.
What if it's the other way around? Like it's a business phone that you use.
Yeah.
Personal.
Yeah, exactly. Tricky to apportion. So a lot of honesty goes in there. So tricky to apportion. So if it's owned by a company, well, it generally wouldn't be paying the phone bill, generally, because who owns the phone, who has the phone account. But if it does, you might want to apportion some in there. It possibly wouldn't go over an FBT threshold, meaning you could say, okay, well, you need to do an add back each year where effectively the company's charging you for the use of the phone, just to keep away from FBT. Yeah. Again, tricky. Yeah. Mobile phones are good. Landline's not so good. Mobile phones perhaps more so you can actually justify it being the company's phone. Landline attached to house, dwelling. Yeah. So your landline, that's what I'm saying, landline one especially, if it's in your name, you can still do a charge to your company or to a sole trader, through a sole trader. Take half of it and claim it. A good claim. Entertainment. Oh, that keeps me busy. Yeah, entertainment and travel. Sometimes I've just got to turn a blind eye. But basically, while you're travelling on business, clearly it's travelling and it's entertainment. You've got to eat, you're away from home. It's deductible, fully deductible. Promotions to the public, certain conferences and other, I'll just park that. 50% deductible, the general rule is dining with a client. So especially if you're in a consulting business and you are entertaining a lot, let's go for a coffee. Your one's actually not deductible, but the one for the client is. You can't sort of sit there on your own. Anyway, you can, but you're promoting something. Come and have a coffee, I'm on my own. Have another coffee. So, and then bars are interesting, it's the same as coffee, but within reason. Moving on. GST, oh yes, okay. So GST rules changed a lot and are still changing. I've had a discussion again around zero rating of taxes. Really complex, separate piece of legislation, basically. Basically, if you are turning over 60,000 or more, you must register for GST, or it looks like you will. It pays to do it early, and there may be times when it's actually beneficial for you to register for GST. Certainly if you're going to have large chunks of expenses at the outset, why not claim back the GST? Bearing in mind you're putting them into the GST pool, so should you sell them, but yeah. So don't always just go, oh, I don't need to register for GST. It can be a good thing. GST is also good as just a side thing that it does kind of force you to keep track of things, because minimum you've got minimum 6 months, but 6 month GSTs, if you're really doing not much at all. But 2 monthly GST means, I've got to do my GST. Oh, that's a reminder to do some bookkeeping and get into it. Do your GST, maybe claim, maybe pay, but and then you sort of know how things are going. There are different types of ways that GST is calculated. Generally for a smaller business, we'll say payments basis is the easiest, because again, it just relates back to what's moving through your bank statement. Money comes in, you've got to pay some GST on it generally, and you spend some money through your bank account, you get to claim the GST. Invoice basis is slightly different. It means that it's calculated on what's actually invoiced, whether you've got the money or not. But then if you get the money, after you've already returned the GST, say a month later, you've already paid the GST. It can work. It can be to your advantage. On a cash business, for example, you'd be paying the GST on the sales regardless, because money comes in, pay GST. If you're on an invoice basis, you can also claim the GST on something you haven't paid for yet. So you bring in your creditors. So, you know, an obvious example would be, say, a dairy or something like that, or again, my hairdresser, but I don't know if she has many creditors. But basically, you know, if you've got bills that come in, you've got to pay them the 20th of the month following, you can claim the GST now in that period, and you've only got to return the income on cash you've actually received. Hybrid basis, I don't know any of my clients who are on a hybrid basis, and I don't know why you would be, because you've got to pay GST on a sale, regardless of whether you've got the money or not, but you've got to return GST on a cash basis, so you can only claim the GST when you've actually paid for something. So, I don't know. It's like, why would you want to be on that basis? But I'm sure that there was a reason there somewhere. Options for filing. GST, you can file monthly, 2 monthly, or 6 monthly. There are thresholds there, but I won't go into it in terms of, you know, regularity of it. Logical is 2 months good, just to help keep track. After 6 months to go trawl through a whole lot of GST, unless it's very straightforward, it's a good idea to do it. GST second-hand goods, again, another conversation I've had already this evening. Do ask me questions later too, by the way, or as we go. So, yeah, I mean, people think, oh, can I claim this GST? I just bought something at the flea market or whatever. Of course you can. It's cost you money, you're in business, regardless of them being GST registered or not, unless there are a few things that sit outside of it, like livestock. Not sure why, but second-hand sheep, I'm not sure. And then the land rules around second-hand goods GST have changed under the new zero rating rules. Again, it's a fluid beast. The requirements are that you've got to just basically, well, prove you bought the item, so you'd have to ask who sold, you know, the name and address of the supplier, perhaps a bit difficult at some of the markets maybe, but the date, it's usually quite clear, description of goods, quantity of goods and price paid, and effectively you're writing out your own invoice for something you bought, and the proof behind it is money leaving your bank account. Totally legitimate. Another question I get asked quite often is, oh, small items, do I have to keep an invoice for it? Well, no is the answer if it's less than $50. Legislation says you don't. But you still have to prove, if required to, you still have to prove that you incurred that cost. So maybe keep a stack of the invoices somewhere. I certainly don't want to look at them. But you know, you total them up through your cash book system and away you go. So, you know, you've got to basically prove you spent the money. Your requirements of a GST invoice. So again, unless you're in a cash style business, you're going to be producing invoices to your customers, and there's certain requirements. It's got to say it's a tax invoice, because there's different, you know, statements come out and credit notes and all sorts moving around. It's promotional material even with prices on it. So it's really clear. It's a tax invoice. This is the document. This is the source document. It's got to say your name as the supplier and of course your GST number, because that's how you're identified. The date, very important. What GST period does it fit into? Description of the goods. It can be doesn't have to be, you know, too detailed. Total amount payable and a statement to say it's inclusive of GST. And again, if it's more than $1,000, the invoice must separate out the GST. This is one often missed, and a discussion I've had recently around disbursements, where, you know, you've got to really, once you get into that sort of figure, you've got to specify this is the GST portion, so there is no confusion once you're over $1,000. Pretty straightforward though. There's templates and things, invoice books available. Compliance requirements, we'd get there in the end. Income tax, as sure as anything, generally. Okay, so tax is payable on the 7th of Feb of the year following. Not saying wait till then to pay it. Or 7th of April if you've got you know, an agent, so you get an extension. Basically, that's so you're not going to have everything known at the beginning, so your accountant takes time to work through it. It's a common thing I hear in first year in business, it's tax-free. And it's genuine, I know. So people say, oh, but I heard it was tax. Well, it's a misunderstanding that tax isn't payable until the year following. Doesn't mean that it's tax-free, you just get a wee while to pay for it. I don't know if IRD picked up on that or not, the people were confused, but they've suggested that if you pay your tax in your first year in business, if you think you're making money, they'll give you a discount, which is, you've got to be paying it anyway. So, and that's not just a discount of interest or anything like that, it's a genuine, hey, we're going to lock 6.7% off your tax, up to the lesser of the tax that you pay, because they can't give you a discount on more than you pay, or 105% of your residual income tax. And I'll talk about residual income tax in a minute. It's a residue. So not a bad idea. If you think, hey, I'm actually doing all right here, I'm going to have to pay some tax. Shame. but might as well have a discount on it, worth doing. And of course, at that time, you're probably talking to an accountant who can give you an idea of the sort of tax you'd be paying based on how you're going, based on your bookkeeping. You can transfer that to subsequent years prior to paying provisional tax. So you might say, oh, well, look, I'll carry that discount, I've already paid the tax, I'll move it forward and use it again, which is definitely worth having if you're growing as a business. Provisional tax. So that's when you're trucking along in business and you're basically paying as you go. So it's split into three, and it's based on the prior year's residual income tax. And just for clarity, residual income tax is the tax you've got to pay on sort of the business income. Because a lot of people have more than one income stream, especially if you're new in business. So you might have a job that takes PAYE tax out. That's nothing to do with the residual tax. That's tax paid on wages as you go. It's part of your gross income. You might have interest, which has resident withholding tax deducted. Again, it's tax deducted as you're earning the interest. The interest, again, is part of your gross income. And then you've got your business income, which is part of that total income for the year. And it's quite possible, well, let's say you made a profit, you've got to pay tax on that income. That's your residual income tax, tax that hasn't been sort of paid as you go. And that's before the calculation of provisional tax. So it's your business income, residual income tax, used to calculate provisional tax. How do they calculate it? Gosh, because I mean, the standard method is to say the prior year's residual income tax, so last year's trading, excluding wages and interest, etc., just business income, plus 5%. And that's pretty fair. Hopefully you're going to do 5% better, if not more, hopefully more. And that's a safe method. And in fact, if you use that method, you're what's called safe harbour. So you've paid your tax based on what they said you had to. And so long as you stay within certain thresholds, if you haven't paid enough provisional tax, interest doesn't get charged, because I can guarantee if you don't pay enough, ID will be looking to charge you some interest. The estimation method is risky and not risky. It's risky if you think you can fool the system. So I estimate I'm not going to pay as much tax, so I'm going to estimate not very much provisional tax. Come year end, oh look, I've got a lot of residual income tax, haven't paid enough, I've estimated, I'm not safe harbour, I'm going to get whacked with my tax bill plus a lot of interest. And interest is calculated not at year end or anything going forward, it's calculated right back when your first provisional tax should have been paid. So the dates are there, the 5th, 9th and 13th month after your balance date. Generally, people have a March balance date. It's the norm. You really want to think why you wouldn't if you didn't. Meaning that your first provisional for any given year, you've started 1 April, that financial year, the first provisional is due 28 August. And if you didn't pay 1/3 of your tax on 28th of August, the interest clock starts ticking, accruing interest based on there, and then going forward. At any time you can pay voluntary tax to say, hey, look, we're going to blow it out of the water. Let's pay some now, reduce our interest bill. There are other options at year end. This isn't on the slide, but you can do what's called tax pooling. So if you get to year end and you haven't paid any provisional tax, even if you had to pay provisional tax and you knew you did, you used the RIT standard uplift method, but cash flow wasn't good, you can use what's called tax pooling. And that is basically buying someone's tax that's paid too much tax back at the time that they paid it. Sounds a little bit complicated, it's totally legitimate. So, for example, Telecom, up and down, or Chorus, whatever now, pay a lot of tax, a huge amount of tax, and they're never going to get it bang on. If they paid too much in any given year, via a tax intermediary, which are approved, IRD approved, and there's only a couple in New Zealand, their tax just stays with IRD via this intermediary. Joe Bloggs, who hasn't paid enough provisional tax, said, oh gosh, I wish I'd actually paid a whole lot back in 28th of August last year and even a bit more into the next year. By the time the accountant's done the books, you can buy their tax at the cost of the tax plus some interest, because Telecom won't do anything for nothing. But certainly lesser interest than IRD would charge you at 8.4% for having not paid it back there. Again, it's a rubbish bank to be borrowing money from, IRD. They're not in the lending game. Terminal tax, it's not what you pay when it's all over. Well, it kind of is for any financial year. So terminal tax says, okay, you had, let's just say you're in normal trading year on year and you paid your provisional as you went through. It wasn't quite enough, but you paid your provisional as you went through, and there's just a little bit more to pay. Oh, darn. And that's your terminal tax. Then you're all squared up. Again, terminal tax is accruing interest. In effect, terminal tax is divided by 3. It should have been paid back again in those provisional tax dates. So though you've got till the 7th of April of the year following to pay it, whatever the amount might be, your accrued interest all the way back from when your first provisional tax should have been paid. Oh, gone to sleep. Alrighty, terminal tax, we're not dead. So terminal tax for the year, as I've been over this, it's the wash up at the end. It's the wash up at the end. And it's interesting, you're paying your terminal tax way down there where you're already paying provisional for the next year, which is kind of a good place to be because it means you can afford your tax, and it's just once you get into that system, as business increases, you pay more, but tax is life. Okay, agent extension granted when engaging a tax agent to complete a tax return. That's just talking about when you need to pay, basically. So having a tax agent gives you a little bit longer. Certainly gives you a lot longer to file your tax return. Again, with a standard balance date, you've got to file in July. So you've got to finish a year and get it all together and fire it all into IRD. But if you've got a tax agent, in theory, because you can actually get longer, but I shouldn't tell you that, March of the following year. So you've got a whole year from balance date. So it gives you some breathing space. Although my thought is you kind of want to know. So you want to have an accountant you can talk to and prioritise. Again, that comes into that good communication where give the accountant good information, give it to them early, keep communication lines open, and things get done quickly. Costs generally keep down too. It's all the stragglers at the end about this time of the year that stress accountants out. And then we're not smiling so much. Right, compliance requirements. Income tax. Again, these are the filing dates. So generally people are going to be on a March balance date. So generally it's, with a tax agent, it's going to be well into the following year. Otherwise, it's the 7th of July on that year. The year just ended. And it says return required by the 31st of March. Again, just quietly, you can get an extension if you're good. Financial year end. Okay, so this is when we start talking about year end, but a good accountant and a good accountant relationship, you're talking with your accountant throughout the year. I love a phone call. I don't charge very much either. I mean, if a phone call, I don't charge at all. Talk to me. Ring me up in the office, give us a ring. Talk about things. How are you going out there? Any excuse to get out and talk to someone just to find out how things are going. And you pick up things throughout the year, not just tax, provisional tax, and tweaking things. However, at year end, if we haven't seen you at all, and people, even if we have, know usually the drill of what's needed, so somehow we need to know what's been going on. Whether it's your manual cash book, and if it's done well, again, we're all smiling because it's just reconciled to your bank, and there it is, and we tune it through, and we can talk about something more productive looking forward. Or access to your Xero, or a copy of the computer backup of whatever you're using. Hands up, I probably won't be opening the computer backup anymore. I'm not so good with that these days. But bank statements, we always want to know that, hey, what you've said actually matches. So it doesn't even have to have all the bank statements, but generally the year-end statement tells us that, well, if you've got it matched to that, it's probably about right. So we need to confirm your balance sheet. Details of cash on hand and petty cash movements. It's good for you to keep track of it anyway, especially as business grows and if there's more than one person in the business. So, see how things go. Schedule of accounts receivable. So unfortunately, even if you haven't received the money for getting GST, you've still got to account for a sale at year end by way of your debtors. So we need to bring those in. So who owes you money? It's a sale made. As is payments that you might pay on, say, on the 20th of April if you've got a March balance date. So your creditors, I owe this money, haven't paid it yet, but you can claim it for tax. So details of those, pretty basic. Details of inventory, if you're a business that has stock, so opening and closing stock, being deductible and taxable, and or work in progress, depending on what you're doing. So, and that can be quite a tricky one. Again, you get into a system of how to work that out. Details of assets purchased, sold throughout the year. If a good, sizable, tangible asset has a depreciation rate, we really need to know what it is clearly. If you lump it into purchases, it just makes more work for everyone to pick back through it all. So identifying it as you go. There's always a good phone call if you're buying a big asset to talk to your accountant. There's considerations to come in. Loan information, if you have liabilities that are business related, for recording certainly in a company its liabilities, but also to ensure the correct interest is being claimed. GST audit trails, often things change. You put in a GST return, what's changed since then. You know, if it doesn't really match your system, then there's something's gone on that's been missed, and that potentially can raise a red flag for IRD. You know, if you've got a taxable profit of X and a GST working backwards, what's your profit, and they don't line up reasonably closely, that'll raise a red flag. The worst audits usually start with GST and then they find something else, because GST is reasonably straightforward. Copies of invoices for significant things, and that's usually just good logic. What's the accountant probably going to want to see a copy of? And details of unusual items or other income. Back to the interest one just briefly, where I saw loans. Yeah, loans. I've been saying to people lately that if they've got a reasonable sized business and a company and they've got personal debt that isn't tax deductible, then I'm probably going to start losing sleep, because often there's a way to move assets and liabilities legitimately through companies to make debt tax deductible. And again, that's getting into high level where you want to talk to your accountant, but certainly, yeah, a phone call with someone I didn't even know, he owned many hundreds of thousands. He was wanting to borrow some money for something. I said, oh, that's all good, and he just rattled off these loans. And I, well, how long have you had these debts for? And then I started losing sleep. So anyway, we're working through it now, and it will be a good legal outcome. So, best practice for bookkeeping. Well, it doesn't happen unless you do it. I mean, you know, unless you're like me and it's your job, you've got to have to stop whatever it is you're doing and look at the books and do the books. Some people enjoy it. It's part of being in business. Yeah, you can hire people to do it. It's got to be done. Xero might make it easier depending on the size of, or another software, depending on the size of what you're doing. This is just common stuff like life. I'm not a life coach, but you know, set time aside for it without distractions. It's a bit like studying, really. You know, you can't sort of watch TV and do the books. Don't know where they go. That won't make your accountant. It might make your accountant smile. You never know. So it's funny what makes accountants smile sometimes. Anyway, when you've finished your GST, close it off and never go back. This is the biggest mistake I see. So for GST, you know, you change something after the fact. Oh, that wasn't a sale, it was a funds introduced, or you know, I had some money and I moved it around. And if it doesn't match, all of a sudden things really go askew, and that's when we stop smiling. No one's smiling then generally. So some people, you know, depending on what you're doing, and if it's manual, close it off, put it in a sealed envelope even. I don't mind. Bring in 12 envelopes for the year. Here's my 12 envelopes, each GST period. Here's what I've been up to. Here's my bank statements. Work through it. It's closed and finished. Yep, retain all records, organised by type and period. Everyone's got their own style. You know, there's shoe boxes and receipts and all the other things. It still happens. You know, but computers are making it so much more straightforward in a lot of ways. And it's a common question, how long do you need to keep your records? Well, it's been reduced, it's now 7 years. So for income tax purposes, that's not trust or company law, just for tax purposes, 7 years to keep a stack of receipts and then start throwing them away. So, you've worked through all of that. You've done a lot of bookkeeping. You've got all this information somewhere, spreadsheets or whatever. After a while, you really start to work on your business as opposed to having to do the bookkeeping and actually start making some use of this information. I've listed a lot of things, but I think tax planning, although it's unfortunate, is quite important. So, you know, you keep an eye on it. You've got a system, so it's I'll just say Xero generic, a computer system. It'll churn out a P&L really quickly, really easily. How am I going this year? Do I need to ring the accountant and pay some more provisional tax? Budgets are great. Once you know what you're doing, you know, your future planning, you can start using those historical information and easily accessible current information to prepare a budget to just measure yourself as you're going through. Otherwise, you know, come to year end and the accountant's telling you. It's better to know as you're going through planning. Monitoring costs is a goodie. You can say, hey, look, we're spending too much on this, what's going on? So you're recording the information, you're required to for GST. Really, it's good to use it. Decision making and long-term planning. So that really comes down to big picture often and doesn't require an accountant. A lot of it's just asking yourself a lot of questions. Then the accountant's probably going to assist you with structuring things correctly for, you know, maximising what you're wanting to do, potentially minimising tax, and lining it all up, reducing risk, which is really where talk to your accountant comes in. So, you know, this isn't a sell for Crow Horwath, but really it's about, as I said at the start, good communication. Hey, here's the business I'm in, here's what I do, here's what I'd like to do, help me with some bookkeeping if that's the case. Most accountants will set you up very well with Xero or whatever you're needing. Here's what I want to do in 5 years' time. What do I need to work towards that? The accountant might have to tease some questions out of you, and often people just don't know. But it's getting those structures in place so you're in a position to make some decisions. And I think that's it. Even the people on their couch generally are awake.